Hey everyone! Ever wondered why financial advisors recommend some funds over others? Today, we're sharing a secret that many financial advisors don't want you to know. Before we get started, a quick disclaimer. This is not investment advice. Every case is different, and we are not licensed financial professionals. Financial advisors often recommend large funds with a mix of stocks to promote a well-diversified portfolio and spread risk. However, you may notice that most of these funds are actively managed rather than passive index funds. Actively managed funds are overseen by professional managers who handpick stocks or other investments in an attempt to outperform the market. While these funds are still diversified, they come with higher fees, known as expense ratios, due to the extra work and research involved. What many investors don't realize is that financial advisors often earn commissions or fees when they recommend these funds. In some cases, fund companies even offer incentives to advisors for steering clients towards specific products. This doesn't mean actively managed funds are bad. They can be beneficial for certain investors, but it's crucial to understand how your advisor is compensated. On the other hand, passive index funds simply track a market index like the S&P 500. Since they don't require active management, their fees are significantly lower. Financial advisors generally earn less when recommending passive funds because there are no commissions or high management fees involved. Instead, they may charge a flat fee or a percentage of your assets under management. This compensation structure often aligns their interests more closely with yours, since they're not incentivized to push higher-cost products. Historically, actively managed funds have struggled to outperform passive index funds over the long term. So, if your financial advisor is recommending an actively managed fund, ask why. After factoring in fees, you might actually earn less than you would with a passive index fund.